Chart of accounts. Since we were talking about chart of accounts in the previous movie, I thought I should also explain you a little bit more about chart of accounts, its bookish definition, plus the form wherein the chart of accounts are defined. So I guess you are fairly clear as to what exactly is chart of accounts. As such, you can see the whole thing as far as our business scenario is concerned. Okay. Anyway, so the bookish definition is the account structure your organization uses to record transactions and maintain account balances is what you call as chart of accounts. All journal entries are created in the context of an accounting chart of accounts. Obviously, you got to have a chart of accounts to capture your accounting entries. A similar example, I have given it over here. So based on what account is hit, you capture that accounting combination, associated currency, and a corresponding date from the calendar that you have defined. The place where you define your chart of accounts in Oracle is over here. You come to General Ledger, Vision, Operations, USA, Responsibility, and then you navigate to Flex Fields, Key, Segments, and here you query a key flex field structure, and within that, this first one, accounting flex field, within that one you define your chart of account structure. So this is the place wherein you define. I'm going to take you to an existing chart of account structure so that you would know what goes into that as a realistic example, which is similar to what I have explained you in my slate over here. Okay, so there is a structure called as operations accounting flex defined for vision operations legal entity, and if you go into its segments, you would see how it is defined. So this chart of account structure, you attach it to a ledger, and that ledger can be shared with multiple legal entities. So as I've explained you, you identify your multiple companies and give them a unique code. So where does it goes and sits into? It sits into this company, and this particular column is called as a segment. So it goes and sits into company segment. And the second segment here you have defined within a company. If you've got multiple departments, you can identify them with a unique code and a description, and under which segment it goes and sits into department segment. Then within each department you've got accounts, and then you can associate a unique numbering for that account, a sub account, and a product account. So all those you can identify using unique codes, and when you transact, it will look like a structure or a combination like this. And those transactions can be viewed as journals in the Journal Ledger module. So if you go to journals, and let's say you go to journal inquiry form, and we say inquiry and then say journal, and let's try to inquire a journal which is been created in a previous period. So let's say I'm going to give a period, I don't know, let me make a wild search, and as you could see, each of these journals have got a associated period, right, and an amount and a currency. At the same time, it will also have an account. So let me take you to a journal, let's say something related to assets, and I'm going to open this. It's going to open a detailed form which will show you what all goes into a journal. So you have a journal header, and what I wanted to show you was a journal contains information such as a date, a currency, and then an account and an amount, right? That's the major components of a journal, which you can view it over the form. Okay, so that's what is the definition of chart of accounts. This is how it is leveraged in a ledger in Oracle eBusiness Suite. Balancing segment. So within the chart of account segment, Oracle gives you an option to define a balancing segment which lets you balance your accounting amounts. In other words, it lets you balance the debit and your credits within your accounting general ledger at a balancing segment level. Usually, a balancing segment represents a unique code pertaining to a company or a legal entity that you have defined within your accounting structure. So the bookish definition is that an accounting flex field segment that you define so that general ledger automatically balances all journal entries for each of the values of this segment. So in our example, if you look at that, what is our balancing segment? Our balancing segment for New Zealand is 01. It is identified as 01. For Australian legal entity, we are identifying that as 02, a unique numbering. And then while defining our chart of account structure over here, in the form I just shown you, this is what the first segment, we are going to call it as a balancing segment. So how do you indicate in the system that it is a balancing segment? You go to flex field qualifiers, and here you've got a flex field qualifier by the name of balancing segment, which is used to identify a segment as balancing segment. So if you want to tell to the system that company is my balancing segment, you come to balancing segment in the flex field qualifier and make sure that it is checked. And then the system will automatically balance your accounting amounts in general ledger. And if there are any discrepancies, then you would be able to view that via a number of reports within the GL system. Now in terms of the balancing segment, for example, if your company segment is a balancing segment, general ledger ensures that within every journal entries, the total debits to company 01, in our case it is New Zealand legal entity which is representing 01, equal the total credits to company 01. So that's the entire idea of a balancing segment. It's very handy to use this segment if at all you've got a complex structure. So let's say if I go back to the structure of Fremont Corporation, and if you've got 3 companies within Fremont Corporation organization, each of them representing a legal entity. So each of them you can represent with a unique code of 01, 02, 03, so that the transactions are pertaining to those 3 separate legal entities and balances at the legal entity level. And then you can consolidate the transactions from these 3 legal entities at the corporate level for your statutory reporting requirements. So that's what is the concept of balancing segment. So as far as an example is concerned, this is how you use it. I've already shown you. You have associate with the company segment and go into the flex field qualifier, define it as a balancing segment. In terms of the values that goes into that, let's look at an example as well for the values. So let's have a look at the value set. You got to associate a value set with a segment. So a value set is the one, it's like a bucket which holds the information. So if you come down here and you navigate to the values here, and here you query by the value set name and hit the find button, it's going to pull out all the values within that value set. So as you could see, each of the companies are identified using a unique code. Let's say 01, 02 for distribution related businesses, 03 for project manufacturing related businesses, and likewise each of the companies within Vision Corporation have been identified uniquely by a numbering segment. And that is what you call it as balancing segment, as long as you have specified that as a part of your accounting structure in your flex field qualifier. Taxation structure. So as I was explaining you in our example, every legal entity is responsible for filing their tax returns. So let's just open the other slide. So let's save this as number 2. I will open this one. So as you could see, here I have specified say income tax ID and a sales tax related returns that have to be filed, and also the employees' income tax are deducted by the company for the salary they pay, and then those are filed as a part of their income tax returns. So these are all income tax returns, and you've got to track those taxes within your system as well. So which includes your trading related taxes like sales tax. Okay, so if you sell something, then you receive the tax of sales tax, and if you buy something, you pay for that tax, right? Similarly, in income tax, the income that you make out of your sales after deducting your income expenses will be liable for income taxes. So expenses could include employee related expenses or company related expenses, right? So for all those taxation related things, you've got to capture all the taxes correctly according to the invoices that you have received or the invoices that you have issued. So invoices you have received means received from the supplier, issued means you issued to the customer for the sales, and your payroll related transactions. So you got to have a proper tax setup within Oracle eBusiness Suite for that, which is where the taxation structure comes into picture. So I've given a simple example over here to let you understand how a tax structure is set up in Oracle eBusiness Suite. The entire tax structure setup is also called as tax regime to rate business process flow. So the first thing you set up in taxes is the taxation authority. So let's say if you are in New Zealand, the taxation authority over here is Inland Revenue. Then you set up a tax jurisdiction. So tax jurisdiction as far as New Zealand is concerned is New Zealand itself. Then you set up a tax regime. So in New Zealand, it is New Zealand as tax regime, one country, one tax. Then what exactly is the kind of tax it is, whether it's income tax, a sales tax, or any other kind of a tax, you set it up over here. Then what is the tax status? So let's say you define the different kind of taxes over here. Let's say there are certain taxes which have got a standard rate prescribed by the government for the trading that you do. There are certain products which are exempt from the taxes. So that's how you define your tax status, such as standard rate, zero rated tax, or exempt. Then you define the tax jurisdiction, which is where you define where exactly the tax will be applicable. So in New Zealand, you've got one jurisdiction, which is New Zealand as a country. And finally, you associate a rate within that. So let's say for income tax, if it is like income tax, then the rate for company taxes in New Zealand would be 28%. Whereas if the tax type is sales tax, then the rate will be 15% in New Zealand. So here I have given another example for the country USA, wherein I have depicted different tax types out here, such as state sales tax or county or a city sales tax, and the tax status is, as you could see, for USA are standard, zero rated, or it could be exempt. In terms of the tax jurisdiction, I've given the example of state as a California and county as a Los Angeles County and city as a Agora city sales tax. And finally, different tax rate examples I have given which are applicable based on the tax information you would like to have it in the system. So that's the tax structure. This is how you define it in the system. Now let's go to Oracle applications, and I'm going to show you the exact form wherein you define this. So I'm going to come out of this, and to define your taxes, you've got to go to a responsibility e-business tax. Let's see if we have that. So tax manager vision operations, that is the responsibility, and within that you go to home, and it's going to open a HTML based form. You can see it's coming up. And as you could see here, you've got a number of steps which are listed, and you follow each of those steps to define your entire tax structure in Oracle e-business tax module. I'm not going to go into the detail of how you do it, which is something I've parked it for a discussion in my other course, which is Release 12i Oracle e-business tax fundamentals, which is where I have explained the concept of tax regime to rate process flow in this module with associated setup and how to go about testing those setup in your e-business environment. Anyway, so that's how you go about defining your tax structure in Oracle e-business suite. And once you have defined that, you've got to associate your tax related information in your ledgers and your legal entity so that it defaults on your transaction. Again, while defining the different transactional related entities such as customers and suppliers, you've also got to attach your taxes there so that the right tax gets defaulted at the transactional level. Business scenario expanded. So far I've explained you our business scenario in very simplistic terms, but that is for like smaller companies. However, Oracle e-business suite is usually implemented for larger organizations which are multinationals, have presence in multiple countries across the world, and they have huge transactional volumes and requirement to capture those transactions and then report those transactions and filing returns against them. So that is the reason I have taken a slightly complex example this time. So in other words, I have just expanded the scenario that I started with. So let's understand that. So it's same thing, Mango Corporation. You've got a business group called as Mango Corporation, and it's got its subsidiary businesses in multiple countries. It's headquartered in Auckland and it's got a Wellington office as well. So the legal entity is established in Auckland and it's associated with a primary ledger. In terms of its operating unit, they would like to segregate the transactions pertaining to procurement, sales and operations. Hence, they've got two separate operating units. One is for procurement, one for sales and operations. Now, within each of these operating units, they've got inventory organizations within them. I'm going to explain you what exactly is inventory organization as we go along, but at a high level, it's more or less like a warehouse wherein you store your raw materials or your finished goods and do the transactions. However, if it's a services business, you don't require this level of warehouses at all, unless you would like to define warehouse for smaller office stationery related items and so on. So as you could see, the Auckland related distribution center has got multiple warehouses. One is in Penrose, then in North Shore, and then in Wellington related distribution center has got warehouses located in Upper Hutt. So that's the organizational chart for Mango New Zealand Limited. Likewise, Mango Corporation has got its subsidiary businesses in other countries such as Australia, Singapore, India, and China. So in terms of their business, they are into the business of manufacturing and selling laptops and server. In terms of services, they also manufacture ERP software and sell them. So the manufacturing of laptop and servers happens in China, which is where they have got a factory located. And within that, they also have a distribution center located in China, which caters not only to the Chinese operations, but also it caters to their worldwide distribution centers as well. So that's the main distribution center, which is where it transfers the items based on the requirements from other countries. So in other words, China has got their factory for manufacturing laptops and servers, and the finished goods are stored in the main distribution center over here. Then in terms of manufacturing the ERP software, they've got their operations in India, and all their support services are also located in India, and the support for that includes for ERP support or telephonic support for the laptop and server that they have sold to the customers. However, if there are any technical difficulties, returns or replacement, those are first taken care by the local business operations in coordination with their factory outlets. So it's a complex organization in general. Now, those were the organizational hierarchy in terms of their legal entity, the ledger. So you've got a primary ledger for New Zealand. That same primary ledger is shared across the enterprise. At the same time, they've got reporting currencies ledgers with different currencies pertaining to individual countries, such as a reporting currency ledger for Australia, Singapore, India and China. You can also define primary ledger pertaining to each of the countries over here, and then you can convert the value for reporting purposes in a reporting currencies ledger associated with this legal entity in New Zealand, as they are the head office. In terms of departments, they've got multiple departments such as marketing, sales, consulting services, support, finance, HR and payroll, purchase, manufacturing and order entry. And they've got many accounts, so I've just noted a couple of accounts over here just for demonstration purposes. Now, the unique thing that you would note over here, that every entity I have given over here has got a unique numbering associated with it. So legal entity has got a unique number 01, Australia has got 02, Singapore 03, India 04 and China 05. Likewise, you will have for the operating units again unique numbering, and inventory organization requires a 3 letters unique code. So for Auckland it's AKL, and Wellington Distribution Center is WLG, likewise for other inventory orgs. Product level, we can include the product in ledgers, so each of the products have got a unique numbering, and then the departments, which is also called as a cost centers, have got a unique identification numbering for them. And finally, the end natural account, they have their unique numbering as well, which is the actual account which will get hit. But to uniquely capture an account in an organization, this whole accounting structure will get rolled up. It is something similar to what I explained you a little while ago, and the accounting combination will be generated automatically by the system based on the transaction that you have performed. So that is a realistic example of an expanded business scenario, which is what we will use it throughout our other courses. For example, explaining you the general ledger setups or taxation related setups or inventory related setups, purchasing, payables, receivables and so on. Everywhere I have used this setup as far as possible. At the same time, there are times I have also used the demonstration instance environment setup, which is of Vision Corporation setup as well. Okay, now other business scenario for your understanding I have taken, which is of Infusion Corporation. So what is that? Infusion Corporation is a business group which has got 4 legal entities under that. Okay, and it has got a total of 400 plus employees and a revenue of 120 million a year. Their product line includes all the components to build and maintain air quality systems for homes and businesses. They've got 2 distribution centers and 3 warehouses that share a common item master in US and UK. So apart from the companies, so these are 4 companies, one for EMEA region, 2 companies are for Americas region, and 1 company looks after their financial services division. And as I said, they've got 2 distribution centers and 3 warehouses. that share a common item master in the US and UK. So to have standardization, they've got a common item master across their all worldwide operations. In terms of the ledger, so each of these legal entity, EMEA has got its own ledger, and the Americas have got their own ledger, and financial services business have got their own separate ledger. And in terms of the operating unit, they have also kept it separately. So for the EMEA region, they've got a separate operating unit, whereas for the Americas, they've got one operating unit for AQM, and for AQM US related businesses and UK related business, they've got a separate business unit. They've got a third business unit for capturing all of their US procurement related transactions, which is linked to AQM. And lastly, they've got a fourth business unit or operating unit pertaining to the financial services business. Alright, so that's their organizational structure. Again, it's at a very high level. In terms of the financial services business, it provides funding to their customers for startup costs of these systems. So I guess these are two realistic business scenarios I have given, which are really real world kind of a scenarios, and one of them we will use it as we go along in not only this course but other courses that we will be taking you through for other modules.